The hardest part about the management business is people, finding people, keeping good talent. I'm not good at hiring people. And I would rather have a company that has, 20,000 units under management that have people ready to go. They've got HR departments. They know what they're doing with getting you people.
What is up, Growth House family? Welcome back to another episode. Today's guest is Vince Giannantonio. And yes, he used to go by Vinny. We just talked about this. He probably hates that I just brought that up.
Starting off on a strong foot. I love it.
You got to, man. So I just want to give people, and I always do this with guests because people always want to ask hey, Jesse, how do you connect with such amazing people? And at the end of the day, it's really through relationships, your network. And one of the best people that I know, Mr. Zach Keeps, is how we got connected. A lot of people that are listening know I host private dinners here in Scottsdale, 7, 8, 9-figure entrepreneurs, sometimes some pro athletes. People actually fly in sometimes just for these dinners. And I asked Zach, I'm like, Zach, who's someone that should be here? He goes, my guy, Vince. He needs to come. Great guy, does multifamily. And if I remember correctly, actually Brett Hundley, USC quarterback, NFL star, was at the same dinner that you came to.
Yes, he was.
So yeah, we have a great time, man. But I just want to kind of give people that background. And Zach, how do you guys get connected? Because I think you actually have a story where it kind of is part of your journey and coming up in real estate.
100%. Yeah. So I met Zach. Man, it's hard to even think it was that long ago because I still think of myself as one of the real young guys, and I'm not anymore. But I met him probably back in 2012. And at the time, I was working as a lease-only real estate agent. So we worked under a property manager, had a brokerage, and their focus was just taking in investor homes. But I was out in the field leasing properties, and that was how I made a living here in Arizona. It was all velocity. And Zach had just really started to gain a lot of traction out here. I got connected with him through another gentleman in the office that I worked with. And as he was buying houses, which I'm sure if anybody has spoken with him, a lot of times he loves to run the dual play, which is, all right, I got a house. I'm going to list it for sale. I'm going to list it for lease. Whoever's first to the finish line gets paid because I don't care either way. I'm happy with how it goes. And I had a lot of success leasing a lot of his houses. So I was his primary leasing agent for probably about 2.5, 3 years out there leasing his houses. And then just over the years, as my career evolved, he continued to evolve and become the monster that he is in that sector. Our paths don't always cross. But it's always great to, stay in touch with him, have a really strong relationship with him. When he came to my bachelor party, it's not like, we just are all business. So, but that's how I originally met him.
That's amazing. Yeah, Zach's always a good time, man. If people that know him, it's just the energy that he always brings. This guy remembers everything, which I still don't understand. That's a superpower that he has. He goes, yeah, that person you told me, that he lists their dog's name. I'm like, bro, how do you remember this?
He's a walking Rolodex.
Really though, but he cares and he actively listens. And once you reach a certain level, you sometimes think, oh, this person is too busy. That's what I love about Zach. Anyone that I get introduced to through Zach is always awesome. And Vince, you're no different. So what I want to actually ask you is, why do you think, besides the fact that Zach was like, okay, this is my go-to guy for listing my homes and is followed through and able to get me renters, what else about you do you think that drew Zach towards you to be like, oh, I want to continue working with this guy? I like this guy.
Yeah, I mean, I was a young kid, a hustler. So while I was doing that, would even back it up before I was doing that. I graduated from Arizona State University in 2009. And anybody who knows the market in Arizona or anywhere in 2009, it was in shambles. And not just the real estate market, but the job market out here was atrocious. So I graduated, had this amazing dual business, finance, international business, mathematics, statistics degree, thought I had everything. And then the market took a shit. And literally, I remember going in and meeting with my advisor when I was in my last semester. You give your resume, they help you with job placement or internships. And I remember sitting there saying, well, what am I going to do? And they just put their hands up I don't know, man, it's a tough market out there. So, I paid my way through school through bartending. And so I stayed as a bartender as I got an internship at Marcus and Millichap as a multi-tenant retail underwriter, where I knew nothing about real estate. It was the only job offer I got. And I worked with this guy. His name is Sanford Burston. old school broker. And I worked with him for about a year and a half, kind of learning a little bit about the business and trying to see if it was something that I would potentially be interested in. And from there, I got my real estate license, started doing some smaller deals on the residential side. The easiest segue to get in at that time was leasing properties, because nobody was buying homes here. The only people that were buying homes, you could probably count them on two hands. And it was the same guys down at the trustees SIPs every single day buying those houses at auction from REO, or even buying short sales for 40, 50 grand a house. And I just was connecting with those people. And because all I knew in real estate was my first job at Marcus and Millichap, which is nothing but investments. And I kind of just circumvented the emotional, end user retail buyer type of real estate, and just got thrown right into the deep end on the investor level, which I know that Zach really resonated, because it comes down to numbers on these deals. I worked two jobs and continued bartending for probably 3 years through my real estate career, until I was really confident that I could, walk away from it, and I was really building something. So I think he saw that I was, okay with burning the candle at two ends with a blowtorch. And I was like, okay, this kid's a hustler. Like, he gets a call on Sunday at 9 a.m., even if he went out the night before, he's going to take that call. He's going to get in that car, drive 50 miles to Surprise to open the door, and he's going to get that rental done. And I was a closer, and I was leasing, 120 houses a year at one point. So I was, you put 25,000 miles on your car. So it all kind of evens out. But, I was there for the long haul. I mean, I had chosen that this was a career path. I didn't want to bartend forever, and I wanted to, build something myself. I've always been a self-made guy, and it was the first time I worked somewhere where the amount of work that I put in, I was rewarded, which I really liked, which I hated about hourly type of jobs. And even working in a restaurant has a little bit of that, right? Like, you work the hard shifts as a bartender, work your way up, you get better shifts, you get better opportunities, bigger tips. You can work more hours, and work mornings and nights, whatever. And I always liked that about that. And real estate gave me that opportunity where I saw real yield from really grinding it out.
Absolutely, man. And I think you're really hitting on, half of our audience that are in that similar position. Like, we have a lot of real estate agents that listen, new investors, and they're thinking about, like, man, it's way harder than I thought, right? Because a couple years ago, everyone was a real estate agent. And now they're like, wow, I can't sell 3 homes, without doing anything a month like I used to. So is that a strategy that you think a lot of them have turned to, or is smart? Like, okay, how about you start also leasing out homes instead of just selling and buying?
Well, I think that good times breeds complacency. And what happens is like you said, you got higher dollar points now. I mean, even back whenever I first started, the average home price, like I said, was under 100,000. So even if you were selling homes to make a really good living, you still had to be slinging a lot of homes. It's not like it is today, where the median price is quadrupled, and people are selling an average house for 350, 450, 550, and that commission is tangible. Versus, you sell a house for 80 grand, you make, before taxes, under $3,000. It's not a sexy real estate type of thing to go to. And the goal was always to try to get into more dispositions, because relative to a leasing commission of, call it $650, $700 that I was charging on mine, it was less velocity, but it never consistently paid the bills. And that was, like I said, for me to walk away from something where I knew if I went into work at 5 o'clock at night and left at 1 in the morning, I was walking out with $300 in my pocket. And in real estate, that you can turn the wheels in the mud all day long and not make a paycheck. But leasing for me became very natural. And because I was so good at closing those deals, and I had a consistent inflow of clients that liked the numbers that I was getting them, and how fast I was leasing their houses, that was like a W-2 job. To me, that's a great way to build, because you have your basis, right? Your overhead is covered. What you're doing on a regular basis is going to cover your house, your car, your food, your basic needs. And then you can focus in your extra time on all the other fun, big stuff as you continue to grow. But nowadays, you go and you call any of the real estate agents, say you want to be a lease-only agent, they'll hang up the phone or tell you to pound sand. None of them are going to do it, because it's not sexy. It sucks. It's very difficult. And at the end of it, you make $700. To me, and even today, like, somebody said they're going to pay me $700, take a phone call and go open a door. Yeah, I'll go do that. Why not? That sounds really awesome. But a lot of people want to do less than that, and they see the next shiny object of, well, my friend got a state license and they sold 3 houses last year and made $60,000. They did nothing. And so you have inexperienced people that are unable to come to the realization that they got in when the market was really hot and it was really easy. And whenever it gets tough, experience is always going to be the cream that comes to the top. And I think that that's really what you're seeing.
Absolutely. Well, walk me through, because you built this skill set now, and then that leads you to the current position and the company that you're with now.
Yeah, so I've had ups and downs too. It's not all a gravy train. So I started as a lease only agent, and that was what I was really focusing on, just grinding it out. And I did that until about 2013, 2014. And I started to, try to figure out what I was going to do. But at the same time, I was a kid in my 20s, right? Like I told you, I graduated in 2009. I'm still living that lifestyle, going out at night, partying. I worked in a restaurant industry. You get off at 1 a.m., you know how it is. You go out till 4 in the morning, right? So back in 2014, and I'm okay, comfortable talking about it with you guys now because it's so far in the past and what I've been able to do. But I ran into a stint with legal troubles because I was, out doing drugs and had a stint with all of that. And I ended up getting arrested in January of 2014, and I lost everything. My car got repossessed by the police because they counted it in the court case. I built up like about $100,000 worth of legal bills just trying to get out of it. They tried to stack like 13 different charges on me because they're all concurrent with each other. And I had to hire an attorney. I lost my real estate license. Like I was crippled. I had nothing. And I ended up having to serve 6 months in jail. Which I did. So through to the end of 2014, from July until New Year's, I was in jail. And when I came out, I was beaten down, real beaten down. I didn't have a real estate license anymore. I didn't know what I was going to do with myself. I basically lost everything. Now I have this record. And, now I couldn't even get a job walking into a Target if I wanted to. They run a background check on you. They wouldn't hire you. So I still continued to try to work a little bit on some real estate stuff, working at property management company that I had helped found at one point and just helping with like the back end operations so that it was stuff that I could do without a real estate license. But again, now I'm a clock puncher, right? I don't have anything. I got no equity. I got no nothing. So I did that for a little bit. And then I was like, I just think that maybe real estate just isn't it. Without a license, I'm paralyzed. So I walked away from that for about a year. And from like 2015 to 16, I worked with another gentleman who was starting a smart home technology company. I helped him with like his back end HR operation, set that up. But I hated it. I didn't like it. I loved real estate. I wanted more opportunities in it. And randomly, my very first boss, Sanford Burson, who's very active in the Jewish community, reached out to me. And he had heard through the grapevine of people about what had happened to me. And he worked with me very close for a year and a half. And he had met another individual named Zev Hendeliz within the Jewish community that had just moved here and started doing some multifamily stuff. And I guess when he was talking to him, this gentleman Zev said, I'm really starting to get a lot of traction in the multifamily side, but it's just me. I need somebody. Do you know anybody? You're in the real estate world. And he's like, I've got the guy. He's like, you're going to be able to pick this guy up from the bargain basement because of his history. And he knew, like I said, he knew what happened to me. So he goes, I'm going to connect you two. You guys should go to lunch. But he goes, I guarantee you're going to meet this kid and this is your guy. So him and I ended up getting a lunch set up. And we sat there for about an hour and a half, talked shop a little bit. I was very transparent with him. I was like, listen, man, I don't have a real estate license. I'm beat up. I'm good at this. I swear I'm out. And, all he said was, are you going to do it again? I was like, no, never doing anything again like that. I'm done with it. And he said, good enough for me. So he offered me a job, making 55 grand to help him turn around an REO asset that he had bought. It was 118 units. I knew nothing about multifamily. I just knew about real estate, leasing, property management, all these skills that I had learned from the very beginning. But all multifamily was to me was just taking all these houses I was working on, putting them into one location. Sounds easy. So I went over to a property he had. It was 70% occupied. And within 2 months, I got it to 94% occupied. And then came into his office and started kind of trying to figure out what my role was, which we didn't really have anything defined. And I said, you know what? Like, I can just be, I guess, an asset manager and show me your properties, give me the numbers, and I'll dissect it all. And that's what I started doing. And, he's given me incredible opportunity to work with him between, equity share, working on these deals, of a magnitude level that I never thought I was ever going to touch, even in early whenever I had my real estate license, especially after everything that I had put myself through. I was like, there's no way. And fortunately, he he gave me an opportunity, and I've been working with him since mid 2016 ever since. And we've had a lot of success. We've gone full circle on probably about 6,000 units all over Arizona. It's probably been worth about $750 million worth of real estate transactions. We currently own 8 different assets, 7 here in Arizona, 1 in Las Vegas, so about 2,100 units that I oversee. And, still very grateful for the opportunity, but still got the same hustle that I had from the beginning because, I keep remembering about getting this second opportunity to, really show what I'm capable of and, who I am. And you want to talk about like a good time to like look at your character and really like look at yourself up and down. It was a blessing in disguise. Like, I still don't recommend it. If you guys can get to going high up in the multifamily world without serving 6 months in jail, I highly recommend doing that. Highly recommend it. But, it was a very humbling experience. But ever since then, petitioned, I got my real estate license back. Took years and had to get it on a probationary license for a while, but got it all cleared, have a full license again. Actually went back, got my general contractor's license. So I have a KB2 dual residential and construction license. And I'm still, kicking strong in the multifamily. So it's been an up and down journey to get here. But like I said, like I've just always had an opportunity to really grind it out. And the hard work thing luckily paid off.
Absolutely. Man, there's so many ways I want to take this. Couple things. First, like appreciate you being just vulnerable and transparent and sharing that past because a lot of people probably would try to hide or run from it. At the end of the day, I always like to ask like what is one of your biggest failures? And we don't like to say it's a failure, more of a learning lesson. What would be your number one takeaway or learning lesson from that situation? And you also take accountability. You said, I put myself in that situation. So
Right.
what's one thing, if you were talking to someone who, maybe is in a situation where they're doing something and like, what would you have wished you would have done differently?
Yeah. Well, what I wish I would have done differently is I wish I would have humbled myself before all the chickens came home to roost. I really thought I was hot shit whenever I was a kid. I thought because I was working hard and you start making money, you start living that lifestyle. That's what's important. And, it was also like getting into that party scene and finally making money in real estate and making money, while I'm bartending. So at the time I just had cash flowing around everywhere. A lot of people that I thought were really close friends with you that you're hanging out with every weekend and everybody wants to call you, hang out with you and do stuff. When I got arrested, they were gone. Like your friend list goes from way up here to nothing. And that was a huge takeaway from me, which is, your friends and the people you surround yourself with, it's not quantity, it's definitely quality. And, that's really what I look for in, relationships with anybody anymore, is, what is the quality of this relationship, that we're going to have, even on a friends kind of basis. I think that that's definitely what I would have learned sooner than finding out the hard way. But the biggest takeaway from this that I can ever give anybody advice that's in a really bad situation is a pretty simple phrase. The easiest way out of the hole is to put down the shovel. What I mean by that is, I had an opportunity while I was in jail to converse with a lot of different, they put you in, in the public population with the people. So there's guys in there for attempted murder, all sorts of different stuff. And the biggest problem that I see is that a lot of these people are in there, they're in denial of why they're there or what they did. And like you said, they don't want to take responsibility for it. It's everybody else's fault. And the only thing they got on their mind is getting out of there and going right back to the same lifestyle. And that's the shovel, man. You just keep digging the hole deeper and deeper and deeper and you don't get out of it. But, if you can focus, and again, like I'm still very aware of it. And like, people are like, oh, you're self-made, you've done all these things. If I didn't get the opportunity and all my other hard work previously, like I don't know where I'd be. So I'm very grateful for the people that have had a lot of faith in me and given me the opportunities. But if somebody gives you an opportunity, you don't squander it. You got to take advantage of it, and you got to really show them what you're worth whenever they do give you that opportunity.
All right, Vince. We're going to transition and talk a little bit about multifamily.
Sure.
So I want to ask this question because this is a question that I've had. I know a lot of investors have this question. We see residential, especially new investors. We're like, okay, I think I can do this, right? Let's do it super simple. House hack, and then maybe buy another house. And then, okay, maybe we buy a duplex and then, quad or, the slow stacking way. But then a lot of people who are way beyond with their portfolio, they're in commercial real estate, they're in multifamily. most investors just try to start with multifamily or commercial? Like, what do you think?
Yeah, that's a tough one. So it's interesting because, like you said, like the mindset makes sense. On paper, you're like, you start single family, you buy a couple houses, then a duplex, then a fourplex, then maybe an 8 unit or a 10 unit. The reality is that the multifamily business model is scalable, but the minimum is much higher than what people think. And what I mean by that is, yeah, let's say you finally get it up, you're like, I got a 20 unit property, right? 20 units. The metrics and the headache that go into a 20 unit property are the same that go into a 300 unit property. And I would argue it's actually more difficult. At 20 units, if you have three vacancies, it impacts your occupancy significantly, especially whenever you're talking about deals that we underwrite, depending on where your cap rate compression is. You need these things at 93, 94% occupancy to cash flow correctly to pay out your investor prefs. So 1 month of three move outs and an eviction, your property's thrashed. Now it is easy to bounce back from it, but percentage wise, it's a significant hit. The second is you got to get to a unit basis where you can have on-site staff handle these things for you. And we look at it on a per unit per annum basis of how much we're going to spend on payroll, whether it's a manager or an on-site maintenance tech to help keep your expenses down for your regular wear and tear stuff. And at 20 units, you can't justify paying somebody $55,000, $60,000 a year to sit there. But at 100 units, you can. So, it's funny because the guy who I work with, Zev, I was always looking at like small deals when I first got started with him. I was like, maybe I'll buy a couple of small ones for myself whenever I really get going. And he's like, those are sucker plays, man. He's like, I'm telling you, if you have, and what he means by that is it's not that those aren't deals; those could still very well be strong deals, but the amount of work that goes into a 20 or a 30 unit is the exact same. You have the same headaches, same problems, and it's just more scalable whenever you get more units. So to your question of like, do you just start in multifamily? I think so, if that's really what you want to do, because there is such a differential of how you operate, how you look at values versus, say like single family or even like a fourplex. People can really look at that on a brick and mortar type basis of, oh, okay, well, apartments in the area go for $150,000 a unit. So I'm getting this for 140 and it feels like a good deal. In our world, that's a little bit, we look at it, but the reality is like, what does this thing do on paper? What does it cash flow at? What are your expenses at? And that's where the asset management side really comes in. And like I said, as you have more units, everything is diluted and it leaves a little bit more room for error on these things versus where, like, if I miss on a due diligence on a 150 or 200 unit building, and let's say we have a roof that we thought was good and it goes out. Okay, it's 35 grand to fix it. Okay, 35 grand, it sucks, it hurts, but you can still do it. You got a roof that goes out on a 20 unit, that's catastrophic. And if you didn't budget for it, you got no money. You're already on razor thin type of profit margins if the thing's not occupied. So I would say that, yeah, if you're going to do multifamily, you got to do multifamily. And even recently, I've done some single family flips, and again, it's just a different skill set. Like my underwriting doesn't always equate from one product type to the other. And I'll be honest, I got a flip on the market right now that I just listed that if I break even on it, I'll be happy. I mean, I might take a little bit, $5,000-$10,000 bath on it because it just reminded me that this is not my product type. This is not my expertise realm. Like I got to go back to the drawing board if this is where I'm going to, try to focus on. So yeah, I
Let
would
me ask
say,
you something right there.
yeah,
Why did you do the flip?
I did it because the multifamily market has been a little bit slow recently. So our market is significantly driven by interest rates. The debt that you put on these things it can make or break a deal. And when we were seeing the hyper rising prices of real estate, it was the same in multifamily. We were tying deals up in 2019 and we go through 90, 120-day escrows. By the time we closed on the deal, before we even owned it, it was worth 20% more. So, we still pride ourselves in that we have excellent asset management. We pay attention to a lot of the in between lines that other investor groups don't. And we've had a lot of success there. But the reality is that if you had a wall with every multifamily address on it back in 2018, and you threw a dart at it and you bought it at whatever they would take for it, and you sold it 2 years later, you made a shit ton of money. You doubled, tripled your money. And again, that same mentality bred complacency even at the institutional level. You see other groups right now, like, I know it's kind of tabloidish, but the realdeal.com, like you see these groups where they owned 20, 30,000 units, but they put, really high leverage, floating rate debt on these deals. And they got absolutely crushed. So while these rising interest rates have been taking place in our world, and especially over here in Arizona, all these deals were in and out, and they were trading at super compressed cap rates. You're talking, 3.5, maybe a 4 cap at one point at the height of the market back in like 2021, because people were so eager just to get in and buy the real estate. They knew it was a gold rush. But when you buy something like that, when you need the leverage that you want, you really only have two options. You have your first option, which is your agency debt, your Freddie Mac, Fannie Mae type fixed rate loans. But when they underwrite, they're much more conservative. You get lower leverage, maybe like 65%, 70%. Or you go to bridge, and bridge is a 3-year term, floating rate debt, but they give you 80% leverage. And when you're talking pref returns and cash flow, that number is significant on what your leverage.
Let's break this down just for our audience. Pref returns. Want to explain that real quick?
Yeah, so pref returns are, if I'm syndicating a deal, if I call you up and I'm like, Jesse, I got this amazing deal. It's a $50 million deal, but we're going to get a bridge loan on it, 80%. So I'm going to get a loan for 40 million bucks. We're raising $10 million worth of equity. Here's our sexy package. Here's our underwriting. Here's where rents are. Here's our business plan. And here's where we think the market will go. Here's our 5-year, 7-year hold strategy of our underwriting. And we believe that with the debt in place that we're going to get and where we can move the numbers and execute, that we can pay an annual pref to you of 7%. Let's call it 7%. So that means you invest $100,000 to me every quarter. I give you your payment to a 7% payment plan for that pref, which is like your interest that you're making on it, or your dividend, whatever you want to call it. We call it pref return. And the vig though is that as these rising values were coming, or as you're adding more value to the property, raising NOI, and you hit with compressed cap rates, and that equation is just cranking out higher values. When we go to sell it, if we sold a deal for 60 million and it was a $50 million deal, it's like, oh, okay, yeah, you made $10 million, but the real number is that 10 million against the 10 million of equity. So now you got double the equity after you paid off the loan for a $10 million jump in value. So now whenever I go to pay you back your 100,000, you've been making your money on your pref returns, but all this excess capital that we got whenever we sold this deal goes to the investors. And usually in syndication, there's what we call a waterfall. So the house keeps a percentage of that extra for ourselves, for our hard work, the good deal, and then everything flows down to the rest of the investors. So now your $100,000 is actually worth $170,000. And while you were waiting for that $70,000 pop in 3 or 4 years, you were also making 8 or 7% on your money. So that's kind of how the payments out in the investment world works when we're looking at syndicating these deals. But full circle, I know we kind of tangent off there. Why I got into the residential stuff. So the floating rate debt that I was talking about, it's assessed every single month, and you actually have to go on the third party market. I don't know as much about this. I know enough to have an educated conversation, but essentially whenever you go and you get these bridge debts for a term, so call it your 3-year term, you have to go buy a rate cap in the marketplace. And basically it's your protection of saying my interest rate on this deal is not going to go any higher than X. Back in 2021, interest rates were like 2.9%. It was super cheap. All of a sudden, as you guys all know, interest rates started to skyrocket and they didn't stop. And as it continued to hike up every month, that interest payment, and these loans, by the way, are interest only payments. So as you're burning through capital, you're not buying down the loan. You're just keeping the business going. Yeah. And so as interest rates went from 2.9 to 3.5 to 4 to 5. And we're like, okay, it's going to stop. The damage is done. Kept going. It went to 6. We have rate caps, on some of our deals previously that were in like the mid sixes. And guess what? They hit that rate. And so all of a sudden, like we have a property, it's 840 units. When we first bought it, our first interest payment was just under $500,000. At its height, it's at 1.1 million. That's on a month. That's the difference in cash flow. There's $600,000 in interest light up on fire because of how fast they move. And because doing anything in the multifamily world with these deals, like it's not like I can call my guy over at Chase and be like, I need a fixed rate loan. Like you got to go through underwriting. There's prepayment penalties on these things, which is another reason that people were so attracted to these bridge debts was not only because of the higher leverage, but because historically for the past, call it 5 years, people were in and out of deals in a year and a half. We would underwrite to 5-year holds and be very conservative. But if we got an offer in a year and a half on our deal that was a 3x on your equity back to investors. So, we executed, we're 3.5 years early. We get a call and the broker has an LOI on the table and we call our investors saying, hey, you remember that $1,000,000 you gave us a year and a half ago? It's worth 3. Do you want to sell it? Absolutely, you would sell it. So with bridge, you only have a 1 year mark to hit until the prepayment penalty goes away. With Freddie Mac and Fannie Mae agency debt, that's not the case. You actually pay the prepayment penalties, which can be significantly heavy. And we actually did a deal that we put fixed rate, and at the time it was like 4.1%, which was a great rate at the time. We put 5-year debt on it. And in 2 years, the debt had dropped to like under 3. The deal was one of those where it's like, it's worth 3x. We're like, well, we got to sell it. We had like a $4 million prepay on that because of the type of debt that we put. It was fixed, it was safe, but you can't maneuver in and out of the deals with as much velocity. And so what happened is we had a market that yielded itself to saying, well, if you want the leverage, you're going to go bridge. If you want to move fast, you're going to go bridge. However, if interest rates pop in a year and a half, then you could be in trouble. And everybody's like, okay, even on a bad day, let's say it goes to 5.5%, we're good. We got rate caps at 6.5, 6.5. It'll never hit. It hit, and like I said, it's interest only payments, so people were just getting absolutely obliterated on these deals. Uh,
So looking at like the good operators versus the ones that maybe were over leveraged, and obviously once the rates went up, what would you say? Like, how do you look at someone like, let's get you guys for example, and everyone else out there who's saying, "Hey, join my syndication." What makes you guys different, and what would be the contingency plan versus other people who are just like, we're just going to go for it and nothing bad is going to happen, and then they get screwed like most people last couple of years.
Yeah, great question. It's hard to spot. And what I would say is what we do differently is, well, we also have a small office. I say we a lot. It's myself. It's our main principal, Zev. I have a director of construction who's a little bit of a boots on the ground guy who does CapEx stuff with me. And then I have a renewal manager. And that's it. There's only 4 of us for everything that we do. And what my job is to oversee every facet of the operations and the business plan from top to bottom. We have a third party management company. And a lot of people who see what I do and what we do in house, they would come in and say, you guys have an identity crisis. You guys are self managers. You guys just use a management company. And we say, yeah, that is right. Because the hardest part about the management business is people, finding people, keeping good talent. And I'm not good at hiring people. And I would rather have a company that has, 20,000 units under management that have people ready to go. They've got HR departments. They know what they're doing with getting you people. On the operational side, though, I would say that we know more about everything that happens at our assets more than almost every other syndicator and operator out there. I know we set our own renewal rates. We go through, we do our in place analysis, which I do on a monthly basis, do market surveys almost daily just to see exactly where everything is. Like I said, the construction projects, we handle them all in house. We have a virtual turn maintenance software where the on site teams walk the units with the inspections, and everything that needs to be done to turn those units feeds into the system, into a turn board. And we make the decisions on what they're approved to do and not do, down to the dollar within our house. And just little things like that. But that's where the asset management is. A lot of larger groups will have a guy who's like, I'm an acquisitions guy. That's it. You'll have another guy who's like, well, I'm a construction guy, but I really only handle the big stuff. You want to replace a roof? That's my department. Do you need to replace flooring in this unit or not? Don't call me. Too small. But that's where the money's lost. And people have kind of been able to circumvent looking in between the lines over the years of doing that stuff because the market was so hot. Hey, who cares? Who cares if I didn't spend that money? I'm tripling my money. Who gives a shit? Well, times get tough. And a lot of these guys are showing an experience where they didn't do this. And one of the things that, I know Zev did, and obviously that I did, is that we didn't just start right at the top and start doing multifamily syndication. We both worked in the field, on the properties, doing the leasing, seeing what the real struggles are. On paper, it's like, move the rents, do this. I don't know why you can't get it. Versus, oh, okay, I've dealt with these tenants before. I've seen what the struggles are. I've seen what maintenance work orders are like, trying to keep people happy or trying to keep people on site that work there. And whenever you understand all of those little things, you can make these decisions much better than a lot of these guys. And again, like, it's hard to get back into the nitty gritty. Like, it's great. You want to sit in your ivory tower in New York, Chicago, LA, wherever your syndication fund is, own stuff all over the country. Yeah, it's great because I never have to deal with it. I look at financials and it is what it is. But as soon as the financials start struggling, you don't really have a lot of solutions whenever you're not the guy who can be the boots on the ground. And that's why we primarily own everything here in Arizona, is because, like, this morning, like, I had a problem with maintenance and unit turns over at one of our properties in Arcadia. I got in my car, I drove 20 minutes, I went over there and I met with the regional maintenance supervisor, with the manager, with the maintenance tech, walked through, walked the ground, showed them, hey, you need to clean this. This needs to be done. This is why we're not, it's a bad tour path. The paint looks like shit. We need to do these things. And it's because we care. And the average person that works there doesn't care. And what I always tell people is, they're like, I got a great, we got a management company. They do all that. I said, okay, well, really the person is your on-site manager. That's who you're talking about. You own a $75 million piece of real estate. You pay your manager $60,000. Are you comfortable with protecting a $75 million investment with somebody who makes $60,000 a year, who has no skin in that game? And if the answer is no, then you need to have somebody who does, who is looking at these things. And that's who we are. We're the guys who give a shit. So when things go wrong, we can step in. And it even got so bad at one of these assets last year, we were struggling to keep a manager. Occupancy fell to mid 80s. Management company had no solution. So I said, fuck it. I'm going to go over and be the manager. And that's what I did. I went over and I sat at that office, and I was the manager of that asset for a month and a half, and brought it back up to 98% occupied. Why? Can't sit around and point fingers all day. At the end of the day, it comes down to the dollars coming in. And your investors don't give a shit if your manager got fired or they're having an existential crisis and don't come into work. Like, they just care about money. And you got to make it work one way or the other.
Yeah, you guys sound like you guys take a lot of initiative and really actually care, and boots on the ground. Like, you're willing to go do something that most people would not. Like you said, they're tens of thousands of miles away, and you're like, no, if there's a problem and I can fix it, I'm there.
Yeah, absolutely.
So who's your dream investor? Because as I've branched out and started my own business, and also like looking for investors, I've realized not everyone who's willing to give you money, you should take money from.
Correct. Yeah, absolutely.
That.
Yeah. Well, listen, 10% of your clientele creates 90% of your problems. And I'm sure every syndicator, if they are listening to this, all has that one guy that was, oh, my friend's dad, wants to invest. He's got 50 grand, and you're raising millions of dollars. And it's always some guy who puts in the minimum amount, who's the guy calling you. Where's my money? Why am I not getting a pref return right now? I don't understand this. You said this was a good deal. And obviously, the market moved in a fashion that none of us would have ever predicted. Otherwise, nobody would be in this position. But I would say that your dream investor is somebody who has invested in multifamily real estate before and has an understanding of it. And my dream investor would be somebody who, over the past 5 years, has lost money on an investment. And the reason is not because I'm planning or we're planning on losing people's money. It's because they understand. And having investors that understand that sometimes, no matter what you do, you can be the smartest guy in the room. You can execute down to the penny. You can make that deal hum. But if market conditions move like they did over the past 3 years, you're just not going to make the money that you thought you were going to make. And if in these situations, if you got an investor who doesn't understand that, it's easy to tell people they're making money. That's easy. That's a great call. Having to call everybody and do a capital call because you need to put an extension on your debt or you need to buy it down or refinance and they're still not getting paid. If you don't have experienced investors, that's a very difficult call. And where you can get yourself in trouble is if you have too many of those. And let's say you got to do a capital call and you got to raise all this money from your investment group. What do you do if they say no? They're like, I don't have any money, man. I'm not putting more money. You haven't paid me anything. Why would I give you another dollar on this deal? That's a hard conversation to have. But when you have people that understand and say, I get it. You guys are making decisions today to protect the funds that are in there. Maybe this isn't a flip that we thought it was. That's fine. If we hold it for 5 or 7 years, is it going to work? Yeah, I think so. Okay. I appreciate that. And they understand. And when we've had the, do ours and we look at our deals and we haven't had problems with that because that's who we've gone to previously. Family offices that are experienced in this, that have felt the pain of the deals and understand that the faith in the syndicator is king. And if you're a syndicator who has performed over and over again and you have a solid plan and showing exactly what it is that you're doing to make the deal work, you will be successful. But it's the guys who moved way too quick, tried to crowdfund these types of things, get every $50,000, $10,000 that they could, and then have to call them up and be like, I don't understand this. All I remember you saying is you were going to triple my money. What happened? So that would be my dream investor, somebody who is invested and lost, unfortunately, but so that they have an understanding of being able to work with you whenever you need a little bit of help or times get tough and you got to try to figure out to be creative to make the deal work in the long term.
Absolutely. As we wrap this up, man, podcast, books, I'm a lifelong learner. I think you probably are as well. What's a little, some advice for maybe top books that you've read this year or podcast you're like, man, people listening would probably love to check out?
Yeah, I mean, I know this is probably beating the dead horse, but this was my Bible, was Rich Dad Poor Dad. It's a classic. I've read other books, the 4 Hour Work Week and all this other stuff. But I take little tidbits away from things. Like I forget what the book was, but there was something that I was like a personality type of test, and one of them in there really resonated with me, which it was a personality type called Maximizer. And the idea is on the Maximizer is you have people that you find what their specialty skill set is, and that's all you focus on, and that's how you thrive. And what I took away from that lesson is if I'm ever doing something that is out of my realm of expertise, I'm going to learn about it, but I'm not going to be bullheaded enough to say, I don't need anybody. I'm a smart guy. I can figure this out. If I need something from somebody, I'm going to go to an expert who is maximizing. That's what this guy does. I got a problem with my roof or a plumber. You call a plumber. You call a roofer. You don't go out there and try to, maybe I know this. No, you find the guy who's the specialty and you surround yourself with those people so that when you're in those situations, you're leading with your best foot forward with having that expertise next to you. And the same is like building a team where, all like these employees, I got 60 different people that work at these properties. I can go through each one of my managers and I can tell you what each manager is strong at and what they're weak at. And guess what we do in my office? We take the stuff off of their plate that they're not good at and we do it. So like, for example, I got a manager at one of my properties. She will collect every dollar of delinquency every month. She will lease ice to an Eskimo. It does it. She can do everything. She, for some reason, cannot get her renewals straight. And what I mean by renewals are expiring leases. She sends her notices out. Her renewal percentages are terrible. She cannot keep people. I don't know what it is. She just can't do it. So guess what we did? We took the renewals in house. Very easy thing. Said, you don't do this anymore. You focus on what you're good at. We'll take care of this. And we did. And now we renew like 80% of our clientele there while she's maximizing and doing what she's good at rather than berating her and being like, your renewals suck. You don't want to beat your people down. I like to play to people's strengths, and I found a lot of success with that. But the thing from Rich Dad Poor Dad that I've always taken away, that I think a lot of people lose sight of, that's my biggest mantra, is live below your means. And what I mean by that, that's a hard one. And like, I think, my experience of going to jail and losing everything really put it all into perspective, because it's like I had nothing. I had to grind my way back up. I had negative dollars in my account. I was on probation, car's gone, job's gone, license is gone. And, I was like, I'm never going to be in that position again. I remember that feeling of not knowing if you're going to pay your rent the next month, where, hey, I got to eat ramen noodles for the next week and try to figure this shit out. So live below your means. You see guys that make that first check and they just start spending, man. And the guys that I've found that are the most successful, and I would say there's a difference in the two words. There's rich and there's wealthy. The guys that are wealthy are going to be the guys that you have no idea that that guy's got any money. He lives in a humble house sometimes. He doesn't drive the nicest car. Maybe drives, like a, 6, 7 year old Toyota. Doesn't always wear like, Ferragamos and the Gucci and all this other stuff. But those guys are the ones where you call them up and you're like, hey, I got an investment. Great. You want 250 grand? Yeah, I got you. I'll wire it tomorrow. And I've always, aspired to be one of those guys, and that's how I even live my life now. Is like, I try not to, ever flaunt anything. I live below my means because to me, it gives you a sense of freedom, where there's nothing nicer than the credit card bill comes at the end of the month. You just hit transfer and you don't have to look at your account. You know it's there. Wife says, hey, you got a wedding in Costa Rica in a couple months. Sure, here, honey, buy the ticket. Whatever. Want to go to a nice dinner night? Sure, whatever. It doesn't matter. And even some of these guys that are making hand over fist money, it's just they buy the next big thing and they never get out of that rat race that Rich Dad Poor Dad's talking about. And it's hard to see. I got a brother who's an attorney, successful attorney at Penn State, and he makes a whopper of a salary. But same thing, man. He's like, I call him up if he wanted to invest, he couldn't invest because he doesn't have the money. And it's like, man, man, you work so hard. Like that freedom of just being able to relax and know, you can just do whatever you want or you can invest. There's a movie called with Mark Wahlberg called the Gambler, and John Goodman's in it. There's a scene in it where Mark Wahlberg's sitting there talking to John Goodman. He's talking, and Mark Wahlberg's talking about like how he lost like $2.5 million, and John Goodman's like, any idiot knows what you do when you got $2 million. $2 million will get you to the point of fuck you. And what he means by that is you put it in the system, you live below your means, you live off of the interest, you get $50,000 a year off of it, and it buys you that freedom just to tell everybody to F off. You don't like your job, your boss is mad at you, F you. Your girlfriend's pissed off you, leave her, F you. Like, because it gets you, that's the fortress of solitude. And I would love to see more people strive just to get to that point, and kind of idolize that situation versus like, I got to get on the yacht, I got to get the Ferrari, I got to do this. So that's how I've always lived my life, especially after 10 years ago. That's my biggest lesson that I've taken, and I live that every day.
That's such a good lesson to wrap it up on, because that is true for someone who's just starting. You have no money because you're just starting and you're not getting paid very much. Okay, why are you getting a new car? Like, let's be smart. Like, if you want to actually make money, you probably should live below your means so you can actually start your first investment. But then, like you said, you can be making millions of dollars, and we both have these friends, and we're like, at the end of the year, end of the month, they're like struggling.
Yeah, end of the month, exactly.
You should not be struggling.
Yeah.
So it's a great reminder, because it's hard, especially in certain cities, in certain environments. And the overall theme, I think, which is our motto, you become who you surround yourself with, Growth House motto, we keep bringing that up because that also impacts, how you live your life, because you have all these influences. You think your 5 best friends are flashing, designer, buying the newest cars when they can't afford it. Guess what? You're probably going to do it at some point. At some point, you're going to cave in. So, man, great reminder. This has been an awesome episode. I love how you shared your story, the ups and downs, even the ups and downs in multifamily. Because some people will be like, oh no, you'll get 12% returns every single year. Nothing ever bad happens. It's multifamily.
That's why I was doing flips, man. You got to supplement it in the interim. Like deals aren't paying out. I got a lot of money parked in deals that aren't paying our prefs out, and it is what it is. But it's the guys who know how to ride the real estate cyclical, man. And people forget that nobody's got long term memory. Everybody thinks it's going to be good forever, and right now it hasn't been good. But it will. And we're buying a deal right now in Indianapolis. We're finding other opportunities, and things like that. But the grind is still there. It's like sometimes you got to get beaten down to understand what you got to do to actually get to where you want to be.
Man, that's a mic drop. We're gonna end it right there, man. Vince, how do people reach out to you? I'm gonna put all of it in the show description, but best way that you like to be reached out to if someone wants
Yeah,
to connect
email
with
is
you.
always great. I love, ever interacting with anybody who has questions, about multifamily. Like I said, like it seems that there's always like gatekeepers, really hard people to get a hold of who want to give you the time of day. I've just always been thankful for the opportunities to get to where I'm at and get the experience that I have. So I love to share that with other people. So, emails if you just have questions, or even if you have a deal that you just want me to look at. I mean, I can underwrite these things in an hour and tell you my opinion on it and what I think or whatever. So always happy to converse with people.
Amazing. Jesse Ray, Growth House Podcasts. Vince Giannantonio, man. Appreciate you.
Absolutely. Thanks for having me, Jesse.